Meanwhile, China keeps on gaining market share. It's in 5-10 years time, China, like on current trends, China will be half of global industrial production. It's absolutely mind blowing. And everybody sits around saying, "Oh, China's about to implode. China's about to implode." And you're like, "No, it's not. It's taking over every industry. It is absolutely not imploding. It's taking over every industry, and that's what we should worry about. Instead of worrying all day about what the price of real estate in Shanghai is going to be, which doesn't impact your life living in London, doesn't impact the life of anybody living anywhere in the Western world. What we should worry about is the fact that they're taking over every industry."
On this episode of What the Finance podcast, I have the pleasure of welcoming back Louis Gave. So Louis is the founding partner and chief executive officer of Gavekal. So Louis, thanks so much for coming on the podcast today.
Thanks so much for having me, Anthony. It's a pleasure to be here.
No problem. Looking forward to speaking. A lot's been happening around the world, and especially where you sort of focus a lot in China. But I thought I'd start very, very broad, very open. You can take it wherever you like. What are you currently seeing in the markets?
Well, again, thanks for having me. Look, I think it was a very tough fourth quarter for myself. I was wrong-footed on a lot of things. For a lot of the people I talked to, you know, basically, if you look at the past few months, you've had some pretty sharp and I would say very sharp moves that were pretty much out of the ordinary. So of course we had the crypto market that doubled. We had a record gap in the a record opening in the gap between U.S. Treasury yields and Chinese bond yields. In just a few weeks, it opened up by about 160 basis points. U.S. bonds sold off hard, and Chinese bonds rallied very aggressively. Within the markets itself, you had a massive outperformance of U.S. large cap stocks, especially growth stocks. So growth massively outperformed value. Large cap outperformed small cap. U.S. outperformed the rest of the world. It was almost as if whatever was expensive, whether gold relative to copper, large relative to small, growth relative to value, Chinese bonds relative to U.S. bonds, whatever was expensive got more expensive, and whatever was cheap got cheaper. And whatever was very cheap, things like Brazil, got absolutely slaughtered. So it really felt to me as if, as we came into the end of the year last year, a lot of people, perhaps, value managers and international managers and whatever else, were basically getting redeemed, and that all the money was going back to the winners of the past few years. And yeah, I got wrong-footed by that. I think a lot of people I talked to got wrong-footed by that. So it was pretty painful. Now, as we start 2025, some of these trends have abated. Some have continued. So Chinese bonds have continued to do well. U.S. Treasuries have continued to do poorly. And some have rolled up, some have turned around. Energy was one of the worst performers last year, and it's starting the year pretty well. So it's trying to put all these pieces together into a coherent narrative is challenging, but there you are. In a world where expensive things get more expensive, and cheap things get cheaper, is a world where most active managers are feeling a fair amount of misery.
Yeah, it has been a pretty amazing, I guess sort of, especially after Trump election win, it seems like, market up, dollar rallied very extremely strong. It's just this
Yep.
sucking up of seems like liquidity from all parts of the world. As you said, people are like, oh shit, I'm missing out on on this. I need to go into the US.
Yep.
It's been quite amazing.
Yeah, no, it definitely felt that way. I think, after Trump's election, the US dollar rallied ballpark 5% if you look at the DXY. But to be honest, you pick any currency, whether the Canadian dollar, the Mexican peso, the euro, the pound, the Aussie, most of them were down anywhere from 3 to 6% following the election. So now, interestingly, there was a similar movement, not quite as pronounced, but a similar movement back in 2016 when Trump won the first time. The US dollar rallied really hard for 10 weeks and basically made a high at the time of Trump swearing in January 2017, and it wouldn't recapture that high for the following 4 years. Um, and so, obviously, that's the question one of the more important questions. I like to say that there's three prices that matter more than any others. It's the price of energy, the price of the dollar, and the price of the yields on long-term treasuries. And if you get these three prices right, then a lot of the other things sort of fall into place. You know more or less how the markets are going to behave. Um, Now, what's been interesting since Trump's arrival is, Trump came in saying we're going to bring down energy prices, but energy prices are actually grinding higher. He came in saying essentially, I want a weaker dollar, but the U.S. dollar has been grinding higher, and U.S. bond yields have definitely been grinding higher. So for now, it seems that we're in a world in which you're getting higher interest rates, higher energy costs, higher dollar, and that's a pretty nauseous combination for U.S. economic activity. Actually, having higher energy costs, higher interest rates, and a higher dollar that's going to hurt your exports and lead to a greater deterioration in your trade balance. You put it all together, this is not a recipe for super strong growth in the United States. So, I think the big question is whether these trends continue. Now, when it comes to energy, I've been, an energy bull. It's been a painful. It was great in 22. It was painful in 23 and 24. Yeah, I think what we've witnessed is really an emptying of storage everywhere, and we're now grinding higher, and that makes sense to me. When I look at U.S. Treasury yields grinding higher, to be honest, when I look at the U.S. fiscal situation, that also makes sense to me. Um, I think it also makes all the more sense if Trump's message to foreigners is not a particularly friendly one, um, and regardless of the kind of foreigner you are. And so you could see how foreign investors seeing Trump come in might say, do I want to stick around in treasuries? Maybe not. So the rising yields also make sense. The part that I'm struggling with, to be honest, is the strength of the U.S. dollar, and that brings me back to the point I just made. Is this an echo of 2016, where the election led to a brief rally and then it rolled over as people started to realize that actually, most of Trump's policies are fundamentally dollar bearish?
Yeah, and I guess could be linked to sort of the increasing yields at the near term, while most central banks are sort of pleading to be able to cut. So you look at yeah, Europe and I guess even China as well, and that they're sort of cutting in. It does seem that the tariff, I guess, threat is also being why a lot of people are sort of being bullish dollar as well.
Yeah, I guess so. And we've had big debates internally here about how bullish are tariffs for the U.S. dollar really. And I've been on the wrong side of that debate with my colleagues. Most of my colleagues felt, look, if we get a bunch of tariffs, um, it will drive the dollar higher because capital spending will move back into the U.S. I tend to view it a little bit differently. I think if you get a bunch of tariffs that end up hurting the U.S. consumer, um, and the U.S. economy slows down, I'm not sure that's great news for the dollar. But um, yeah, regardless, I think the consensus opinion today very much is, yep, tariffs equals stronger dollar. Um, but then again, he comes in when he got elected. He promised that on day one I'm going to do a bunch of tariffs against everybody. I love the word tariff. I'm going to use it here, there, and everywhere. Um, and then he comes in, and all of his executive orders were really around, I would say, societal issues, cultural issues, much more so than any economic issues. They were actually, when you go through, all those executive orders, there wasn't that much linked to the economy in there, and there was nothing on tariffs. So much so that during the press conference, he said, "Well, look, we might still do tariff on Feb 1st against Mexico and against Canada, um, but sitting here, I'm calling you from Hong Kong, and obviously we do a lot of business in China. Looking at it from a Chinese perspective, so far it feels as if there's been nothing for China. Like it's felt not so bad. Now, granted, we're 3 days in, so this could, by the time you publish this, I could be made to look like a complete idiot, and you could have had a bunch of new tariffs put in against China, but so far we haven't seen them.
Yeah, I guess what is the expectation of the US-China relationship over in Hong Kong? Is it sort of, I guess, a little bit concerned about what could happen, or is it just uncertainty? What's
Yeah,
the
it's,
perspective?
I think it's more uncertainty than concern, to be honest. The China-U.S. relationship has been deteriorating for 8 years now, and the Chinese leadership has done as much as they, I think, possibly could to cushion their economy against potential further deterioration in the U.S.-China relationship. Now, I think the perception, both in China and in Hong Kong, vis-a-vis President Trump, is that President Trump is first and foremost transactional. Uh, that his main reproach against China isn't an ideological one as much as an economic one. It's like, look, you guys stole all our jobs, and you moved all the factories moved to you, and you're running these massive trade surpluses, and you need to buy more from America, et cetera, et cetera. All of which, China's happy to have a discussion around, I think. Um, the problem, I think, for China with the Biden administration, in March 2021 or May 21, Anthony Blinken and Jake Sullivan sat down with their Chinese counterparts in Anchorage, Alaska, and basically sat down and said, "Look, you guys are a dictatorship. Uh, you're not a democracy. We don't want to do business with you. We think you're fundamentally bad guys." At which point, the Chinese staff said, the Chinese said, "Well, you could have told us this over the phone. That would have saved us a 12-hour flight." Um, and in the following 3 years, Jake Sullivan, the national security advisor, didn't make it to China once. He was the first national security advisor to not visit China up until the time when Biden had already lost the presidency, and sorry, Kamala Harris had already lost the presidency. He only came to China for the first time in November of 24. Um, and Biden was actually the very first U.S. president since Richard Nixon to not visit China. So the relationship, I think, in the Biden years really fell to new lows, and I think the perception is it's going to be tough negotiating with Trump, and it's going to be a pain in the neck, but it will likely make for, nonetheless, the relationship will be better. Um, and I think you saw this with Trump's invitation to Xi Jinping to come to his inauguration, an, um, an invitation that Xi Jinping didn't take up, but he sent his vice president, Han Zheng, who sat down with J.D. Vance for a one-on-one meeting. So it seems like bridges are being rebuilt. Now, whether, goods and services and people start to travel across these bridges, time will tell. But at least there seems to be an effort to build bridges again rather than blow them up.
Yeah, that ideology perspective was so weird to start with. They went so very hard at Saudi Arabia, as you said. They
Yeah,
went hard at China as well, but then they seem to be quite weak on other countries like Venezuela and sort of Iran. So it was a really weird concoction of, yeah, I guess ideological push. And then when they got pushed back, and when oil prices went up, they're like, oh, we need to go back to Saudi Arabia.
yeah. I think
Quite
I think
naive.
there was a lot. To be honest, the Biden administration felt like it was uh, the primary driving factor of decisions was virtue signaling first and foremost. Um, and it was just a constant virtue signaling attempt on absolutely everything. It felt like that's what drove policy. Uh, the problem is, when it comes to foreign policy, you have to have a certain dose of realism. And the whole, we're not going to talk to China because you guys are a dictatorship. When it's, the world's second largest economy, that doesn't make much sense to me. So on this front, again, I think uh, the foreign policy under Trump. I'm not saying it's going to be all roses and friendship holding hands and watching sunsets together. Um, that seems highly unlikely. But again, if at least bridges and channels of communications reopen, I think we can only welcome that.
Yeah, definitely agree. So I guess we'll have to, it's probably time to get to China. It's been a really interesting past couple of months. I think what last time I actually wanted to speak to you was when they sort of announced this big push. They were going to say they're going to provide all the support, and then since then we've seen to get an array of, I guess, new ideas or new things that they're sort of trying to implement throughout the economy, but nothing really massive and nothing that's actually helped to, I guess, turn around the perspective and the economy overall. So can you maybe give your overview about what we've seen in China over the past few months?
Yeah. So, okay, I'm going to answer your question with another question because I think it's important to first, put up some facts. Obviously, China last year had the best performing bond market of any major economy. It's had the best performing market on 1 year, 3 year, 5 year basis. Now, last year, if we switch gear and you look at the SPX, the big S&P 500 ETF trading in New York, that was up 24%. Do you know what the FXI was up last year? The biggest China ETF. Um,
No, I have no idea.
yeah, so that was up 28%. So everybody says, oh, China is terrible, it's a disaster, etc. It was a disaster in 22. It was a disaster in 23. They kept their economy locked down for COVID way too long, way past everybody else, and that carried a big economic toll. Um, but there's still this perception out there that China, is this is basically circling the drain and caught in this doom loop. Um, but if you look at last year, Chinese banks were actually amongst the best performing banking sector in the world, and which you don't really equate to an economy that's doing terribly. Now, the other perception I think in the Western world today is, yeah, China's not doing enough. The government should be doing a whole lot more. Now, interestingly, I think what China's doing is very reminiscent to what we did in the Western world in 2009, 10 in the US post the GFC, and in Europe post 2013, post the European crisis, which is essentially quantitative easing. Um, and so today, what are you seeing? You're seeing bond yields collapse in China, and nobody's stopping to say who's buying all these bonds. And the answer is the central bank is buying these bonds. And the central bank balance sheets is growing rapidly. The Chinese budget deficits are growing, and the central banks out there buying these bonds, and the yields are collapsing, which is pretty much the policy response that we had in the Western world in 2009, 2010. Incidentally, in 2009, 2010 in the US, everybody was running around saying, oh, it's going to be a lost decade. It's going to be Japan all over again. And interest rates are going to stay low forever, and equity returns are going to be terrible. Meanwhile, it was an amazing 15 years for stocks. Obviously, if you bought in 2009 and you held on, you've been laughing all the way to the bank. Now, I highlight all this because today in China, what do we have? We have a situation where valuation on stocks after a horrible 22, a horrible 23, valuation on stocks are basically in their bottom quartile. You have very, very clear policy signaling with both fiscal policy and monetary policy easing, government saying, look, we're just going to throw money at this until something sticks. And then finally, you have very, very low interest rates, that usually tend to support asset prices. So you basically have the trifecta: policy support, low interest rates, and attractive valuations. And yet, yeah, to your point, most people aren't interested, which actually gives me a lot of comfort. It means that this can easily keep going. We've just had a year where China's actually outperformed the U.S. and while the U.S. was having a monster year, and nobody knows, nobody cares, nobody talks about it, which to me is fascinating and frankly quite encouraging. The Now, and I think the reason nobody cares goes back to our own stimulus. Uh, I think if you look at China's doing what the West did in 2009 and again in 2013. Um, but then what we did in the Western world in 2020, when we hit COVID, is we basically sent checks to everyone, right? We sent checks in the mail to everybody. It's like, here's money for you to watch Netflix. Here's money for you to play video games. And a lot of that money ended up finding its way to the stock markets, and the stock market went bananas. In 2020, this is when you had all the GameStop craziness. This is when Peloton was a $50 billion market cap. You had a lot of things in the market that suddenly went absolutely bananas. And from there, I think in the Western world, we've developed a mentality that, hey, when things don't go well, the government should really send checks to everyone. And if they're not sending checks to everyone, then I'm not really that interested. If they're not sending checks in the mail, that means they're not really doing stimulus. But China is doing stimulus. The economy, you've now had 3 consecutive months. Now it's only 3 months, but you basically had 5 years where real estate prices and the transaction numbers on real estate were literally falling every month for 5 years. You've now had 3 months where those have been picking up. Now, granted, it's only 3 months, but if you get another 3 months, and I think you will, because mortgage rates have just gone from 6% to 3%, because the equity you need to put down to buy a house has gone from 30% down to 10%. So you put all this together, and if you get another 3 decent months on real estate, then people will start to say, hold on, that's now 6 months where real estate is ticking up. Maybe we have made a bottom. And if we've made a bottom on real estate, the whole fear of China circling the drain and the big deflationary bust and the balance sheet recession, etc., all that will abate. So to me, we're at a fascinating juncture today where China is stimulating, but everybody says it's not enough. Uh, the market, the equity market is doing okay, and nobody cares. Bond yields are at record lows, which means that every Chinese pension fund, insurance company, and whatnot is going to have to be selling bonds to buy equities to rebalance their portfolios. So I think it's an interesting time.
Yeah, really interesting, as you said. It's just something that's got under the radar in a lot of places, or people are looking at it always for the worst reasons rather than these positives. And it does seem like it's a very different economy. Where in the US or in Western countries you need sort of the fiscal support to get money to the people. Most of the banks are sort of state run or sort of So then that way that by providing this, I guess QE, you can actually
Yep.
then support it through those banks, and it seems like that's what's been happening
Yeah.
as
Look.
well.
Yeah. I think that the really big shift in China is a pretty simple one. Is that in 2018, when the U.S. government said nobody's allowed to sell semiconductors to China anymore, what you had at that time was the Chinese government basically panic. Uh, they thought it's semiconductors today. Tomorrow it could be auto parts. It could be telecom systems. It could be generators. Like who knows? We need to be independent on every single industrial vertical. Uh, Otherwise, the West may try to trip up our economy by preventing us access to what we need. Um, and so in 2018, the order was given to the banks, guys, no more loans to real estate. From now on, you're only lending to industry. Now, for 6 years, everybody focused on the real estate bust that came from that very order, and everybody missed the industrial boom. So now we wake up suddenly in 2024, and it's like, oh my God, China's producing much better cars at a much better price than what we have. Better industrial robots, better tractors, better telecom switches, better solar panels. It's industry after industry. They're crushing us, and even to be honest, on some of the non-industrial stuff that we thought only the West could produce. And obviously here, there's the whole discussion around TikTok, the whole discussion around Xiaohongshu. You now have, DeepSeek, the AI that's outperforming OpenAI and ChatGPT, etc. So all of which makes sense because China today produces more engineers than the rest of the world combined. But so that was a huge transition in China from a real estate driven economy to an industry driven economy, and so that brings you to today where China basically has excessive production capacity in pretty much any industry you care to think of, and that's very problematic for the rest of the world. It's problematic for the German automakers. It's problematic for the Swiss industrial tools makers, and so on and so forth. Uh, but yeah, so that's the world. That's the world that we live in. And meanwhile, China keeps on gaining market share. It's in 5, 10 years time, China, like on current trends, China will be half of global industrial production. It's absolutely mind blowing. And everybody sits around saying, "Oh, China's about to implode. China's about to implode," and you're like, "No, it's not. It's taking over every industry. It is absolutely not imploding. It's taking over every industry, and that's what we should worry about. Instead of worrying all day about what the price of real estate in Shanghai is going to be, which doesn't impact your life living in London, doesn't impact the life of anybody living anywhere in the Western world. What we should worry about is the fact that they're taking over every industry."
Yeah, sort of, and this might be a bit of a stretch, but I feel like it seems like what the US was in the 1930s, sort of before the Great Depression, massive export economy. They brought in tariffs, which sort of just destroyed that. And then they went into a depression because it was sort of overcapacity. And then from that, they emerged after World War II, this massive production, and then consumption sort of came into the economy. And then they were able to, still export a lot, but they were able to actually consume a lot as well. And I think that seems to be the missing piece in China at the moment, where there's only so much you can continue to grow. It already seems like markets are oversupplied. There's frictions with external partners. It does seem like there needs to be a point where, while they are consuming a lot already, it needs to sort of continue to grow. Do you see that as
Yeah.
a risk?
Well, I think this is the interesting development right now, right? Because you had this huge shift in 2018 when the leadership basically said, "All right, we're closing the door on real estate and we're opening the door on industry. We're going to transition our economy from one to the next." And right now, the big question is the one you just raised, and is all the stimulus that we're seeing, is that a sign of, uh, you know, uh, you know, when they come out and they say, "Look, we're going to build up our social security system more deeply," which is what Pen Gongchang, the PBOC governor, said in a conference here in Hong Kong a couple of weeks ago. When they come out and say we're going to do more subsidies to consumption, etc., are they now starting to say, "Okay, now that we dominate every industry, now that the Western world can't really squeeze our economy by blocking us from petrochemicals or blocking us from auto parts or whatever else, now that we basically produce everything, and we're thus independent, can we relax and have a little bit of a good time, and have a little bit of a consumption boom?" Now, one of the ways to track this, I think, will be to look at bank lending, at what happens to bank lending, because logically, now that they've, basically gotten to where they wanted to get to in industry, you should start to see bank lending to real estate pick up again. And lo and behold, it is like slowly, very slowly, but it seems to be happening, um, which, explains why you've now had 3 months of improving data. And um, and so if you start to see that, that will be essentially the third turn for China, um, in basically the past decade or the past 15 years.
Yeah. And is it all linked to the lending, or is there sort of other
And
things
by
you
the
think?
way, sorry to interrupt. And the market is absolutely not priced for that, right? Because the market has been so focused on, "Oh my God, it's balance sheet recession, real estate is going to implode, it's Japan all over again, etc." But the market is very much priced for that scenario. Meanwhile, the policymakers are saying, "No, no, 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 no. We're going to like step on the gas and we're going to get consumption up." So from there, you have, you know, in my career in China, I find that policymakers have had a pretty decent track record of doing what they say and saying what they do. So right now they're out there saying, "Look, we're going to step on the gas and get consumption going again." So that you can have three possible conclusions when they tell you that. The first is they're not going to do it and they're lying to me. Uh, but then why would they lie to you, right? The second possible conclusion is to say, well, they might want to do it, but they can't because again, it's Japan all over again, and bad demographics, and they might step on the gas, but they're pushing on the string, et cetera, et cetera. So that's the second, and I think that's where most of the market is today. And I think that there's an argument for that. Like the first argument is they're lying to me. That one I don't have much time for. The second argument is they might want to do it, but they can't. And the third possible conclusion is to say they're telling you they're going to do this, and they're going to do it, and it's going to happen. And clearly that's where I am. But I can see why a lot of people believe in the second scenario, again, pointing to Japan and saying, look, it didn't work in Japan and it won't work in China.
Yeah, thanks for adding that. So, you said you're looking at sort of real estate, increasing of loans. Is there anything else you're looking at to say, okay, this is actually starting to, I guess, take hold?
Yeah, so look, there's lots of I think when you look at China, you can't hang your hat on just one number, right? It's a little bit like I always say China's like an impressionist painting where you have to get as much data as you can from the markets, anecdotal evidence, corporate visits, company visits, etc., what policymakers say, and you put it all together. And just like an impressionist painting isn't exactly a description of, let's say people having a picnic next to a lake. You can tell it's people having a picnic next to a lake, and you can tell it's a tree over there. But perhaps the tree, you're not quite sure what kind of tree is it. Is it an oak tree? Is it a chestnut? It's not very clear because it's an impressionist painting, and that's how China is. So yes, I think keeping tabs on the real estate data is super important. Keeping tabs on the stock market and the flows that you're seeing in the stock market is super important. Keeping tab, of course, on what policymakers are doing, and if they're continuing to send you signals, look, we're stepping on the gas. And today again, we had some announcements that they are stepping on the gas. You want to look at some of the other. You could say a lot of people love looking at the electricity data, and we look at the electricity data as well because you get it almost in real time, and it's an indicator of growth. Having said that, the problem with electricity data is it's extremely sensitive to changes in the industrial growth. What you're looking for now is, am I seeing a pickup in consumption, et cetera? So then you look at things like tourism numbers and domestic travel, international travel, restaurant sales, and yeah, so many ways to skin a cat. All you can do is bring in all these data points and try to see whether some kind of image emerges out of this, acknowledging that you'll always have outliers, data that either reinforce too much or negate what your premises are.
Yeah, I really like that analogy of the of the painting. It's a pretty good way to put it. And is it sort of reliant, I guess, on this foreign investment to, of foreign investors to come back into the
I
market to
don't think it is
gain
at all.
faith?
No,
No.
no, it's not reliant at all on foreign investors. And I think this is perhaps one of the parts that the Western world is missing. Is China's running a trade surplus of $1 trillion a year now. No country's ever run a trade surplus of $1 trillion. Like the biggest trade surplus up until 5 years ago, up until China, was basically Germany, Japan running trade surplus of 200 to 300 billion a year. A trade surplus of $1 trillion a year is just gargantuan. So the problem in China isn't a lack of access to capital. Nor is it a lack of savings, because you got very high savings rates in China, et cetera. The real problem in China today is a massive lack of confidence, lack of confidence amongst entrepreneurs, and lack of confidence amongst young people. Lack of confidence amongst entrepreneurs because they keep being told that the U.S. is going to do 60% tariffs and Europe is going to do 60% tariffs. So today, if I'm producing shoes for Nike, maybe I'm making lots of money. Maybe my factory is super productive, and I should be building a second factory. However, I keep hearing how there's going to be a bunch of tariffs, so I just sit on my hands and wait and see. Most business people just want to know what the rules of the game are. Very few of them are ideological. It's they want to know what the rules of the game are so they can build their models and they say, okay, I make this investment or I don't. And I think in the past 5-6 years, part of the problem in China has been both internationally and domestically the the political environment has been really uncertain. Domestically, it's like, okay, we're cracking down on real estate, and we're cracking down on internet stocks, and we're cracking down on education stocks. Then we're locking down the whole population for over 3 years. So you put all this together, and if you're an entrepreneur in Shanghai or in Guangzhou or wherever, your willingness to take risk isn't what it used to be. And then so that's for the entrepreneurs. And then if you look at young people, basically the 25 to 40-year-olds, the millennials in China today, large number of them bought real estate at the wrong time with a lot of leverage, and their balance sheets have been, their balance sheets have been torn to pieces on the back of the real estate bust. And so there they are, you know, sort of stuck in apartments that they can't sell because they might even be in negative equity sometimes, which means that there's it curtails their job opportunities because you can't really move. So it's so those are the two big problems in China today. Basically just destroyed confidence, and that's what you have to fix for. Now, if you manage to get real estate going again, that definitely fixes for a lot of that problem. So, sorry, going back,
Yeah.
there's a lot of very high savings. Like people are sitting on a ton of cash. That's why bond yields are so low. The banks have so much cash, they don't know what to do with it, so they keep buying bonds because nobody's asking for loans, etc. So you don't need foreign money to get things going in China. You just need a change of domestic confidence because there's plenty enough domestic money to get things to fuel a bull market.
Yeah, I guess it sounds so similar to what we've seen in Europe, like, without the property crash, probably. And I imagine if that were the case, then it would be, yeah, similar situation to what's happening in
Yeah,
China.
I think Europe is more screwed, actually, to be honest. In China, you have a super cheap cost of electricity because they've actually made a ton of investment. They didn't shut down the nuclear plants. They've, you know, they didn't prevent the building of hydroelectric dams, um, and they kept burning coal. So today the cost of electricity in China is amongst the lowest in the world. I think Vietnam is marginally lower, but there's not a lot of countries that have a cheaper cost of electricity than China today. So that's a big difference with Europe. To be honest, I think like the other difference with Europe is, I said China's leapfrogging the Western industry after industry. That's a real problem for Europe. For Germany, for Holland, for Northern Italy, it's Eastern France, all these places where you still had a fair amount of industry and manufacturing. That's right in the target zone of what China's producing, because what China's done in the past 5 years as it's plowed money into manufacturing is it's moved from being a cheap producer of cheap products to actually producing products that are now very often of a higher quality than what we do in the West. And where this is quite obvious is the cars. Like a lot of the Chinese cars are now cooler than the cars we do in the West for a fraction of the price.
Yeah, I do think Europe's been basically the biggest loser throughout this increase in manufacturing in China. That's
Yeah.
definitely what it's seemed to be. So, another point I wanted to touch on was, I guess, the Chinese currency and the yuan. And I think there's been a concern that that's what's been holding them back from fiscal support. I know you said there's been quite a lot of QE actually in the economy, so maybe that's not the case. But is that another thing that may be preventing them from making these massive announcements? Just the rising dollar and the concern of the currency.
Um, could it could? I mean, obviously, the renminbi has weakened against the U.S. dollar, but it's done very well against the yen and against the euro, and so the renminbi has remained a low beta currency because it at the end of the day remains a managed currency, and it's managed against a basket, etc. And yeah, maybe it is one of the things holding them back, but again, I'm not sure they're being held back that much. It seems to me like every month they're announcing something new. It's just that we have this perception in the West that if you're not mailing checks to people, you're not doing it right. And this is something new. I would say that if we were having this conversation in 2019 and we never knew about sending checks to everybody, right now we'd be saying, oh, China's doing a lot of stimulus, and we'd all be agreeing that China's doing a lot of stimulus. But because we've completely moved the goalposts in the Western world with COVID, um, what China's now doing feels small by comparison to what we did in COVID. But let's not beat around the bush. What we did in COVID was completely blow up the balance sheets of our governments, and we're still paying that price today with an inflation rate that we can't get back into the bag. We let the inflation genie out of the bottle. Sorry to mix metaphors. Um, and what we're now saying to China is, look, you have to do the same. You have to go pedal to the metal like we did in 2020, and hereby trigger higher inflation in your own economy. Now, the appetite for that in China is basically zero. I think if you were brought up in the Marxist church, if you're a communist, um, like the Chinese leadership is, if you were brought up in the Marxist church, you tend to believe that big changes in history, revolutions and the like, occur not because of ideas or not because of charismatic individuals or anything like that. It happens because of economic forces. From Karl Marx, economic forces shape history, and there is no more powerful force than inflation. So Marx explained, you get bad harvests in France, price of bread goes up, and next thing you know, Louis the 16th's head is on a spike. And so I'm not saying that I believe that, by the way, but the Chinese leadership very much believes that. Not only that, it's been ingrained in their DNA. Most of the Chinese leaders today would have been between 25 and 35 when Tiananmen happened in 1989. Now, in the Chinese Communist Party sort of catechism, the idea is that in 1989, the kids were demonstrating. They were very unhappy because back then inflation in China was over 20%. China started opening up a little bit, and so inflation was above 20%. Next thing you know, popular anger, students start demonstrating, and then workers start joining in with the students, and so they have to put this down. Now, for the current leadership, you know, the guys who were put down were students who went to Beida, to Beijing University, who went to Tsinghua. These would have been their little brothers, their little sisters. These would have been their cousins. These would have been, imagine, and these would have been the cream of the crop. The guys who went to Beijing University and Tsinghua in Beijing at that time, this is like going to Oxford or Cambridge in the UK or to Harvard and Princeton in the US. And so imagine if when you're 25, 26, 27, the cops come in and kill a bunch of people that are just a few years behind you at university, to the same university you went to. That would be quite traumatic. So I highlight all this because, the one risk the Chinese government will not take is the risk of inflation, because it is seen as being profoundly socially destabilizing. So they will, they're always going to err on the side of caution. And so, which goes back to what they're doing right now in terms of stimulus. You could say, well, they should come out all guns blazing and do a massive thing. And instead, they're doing like bit by bit. I think it goes back to this fear of inflation. They're afraid. What they just saw in the West in 2020, coming out all guns blazing, huge, huge stimulus, and then a year and a half later or 2 years later, massive inflation, they really have no interest in, and they're never going to do it.
Yeah, it's really interesting. Not something that I sort of realized that was a major influence of the past issues they had. But Louis, thanks so much. We've sort of gone in all different directions. I feel like we've covered most of China and what could happen. But yeah, my last question is: what is one message you want people to take away from our conversation?
Look, I tend to be a pretty cheerful guy and an optimistic guy about the future. I'm optimistic that the U.S.-China relationship is going to improve from here. Um, I'm optimistic on the outlook for Chinese equities from here. Look, I think we live in a world right now where you're getting easier fiscal and monetary policy in China. You're very likely to get easier fiscal policy in Europe once you're past the German election, and probably easier monetary policy in Europe as well. In the US, I think, President Trump isn't the kind of guy who's going to slash government spending massively. So you're going to maintain pretty easy fiscal policy. I doubt it gets easier from here. So at the margin, while it's going to get easier in China and easier in Europe, in the US, we probably, we stay with big budget deficits, but I can't imagine they amplify from here. Um, do we get easier monetary policy in the US? I think that's a big zone of uncertainty. It seems pretty likely to me that the Fed is getting close to done. Um, but all this seems to me an environment that's not so bad. Like I said, I'm a pretty cheerful guy, and yeah, I'm looking forward to the coming year. Actually, I think there'll be a lot of money making opportunities, and I think there'll be a lot of money making opportunities in my part of the world here in Asia, where things have been pretty somber for a few years, but last year wasn't so bad, and this year is starting off okay.
Perfect. Great message. So, Louis, thanks again. If anyone wanted to find out more about your work and what you do, where would the best places for that be?
Yeah, absolutely. So really, we do three things. So we're based in Hong Kong. That's our headquarters, but we do mostly three things. We do research for institutional investors. We have an asset management arm for institutional investors, and then we have a private wealth arm for private clients. You can find out more at gavekal.com, which is our website, Gavekal, gavekal.com. And you can also find out more. Well, no, you can just follow me on Twitter. I'll post the occasional thing. Um, yeah, so my Twitter handle is at gav.vincent, which is my middle name, Vincent, Gav Vincent. So feel free to follow me there.
Perfect. I'll put it in the description below, but thanks again for your time.
Thanks again, Anthony. Thanks for having me.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right, thanks again.